on June 2, one question hit India's reserves. Why sell gold? Because Bloomberg Economics reads the RBI data as something unusual, the analysis estimates gold worth roughly $12 billion likely moved over the fortnight ending May 22, according to that same reading, while foreign currency holdings appear to rise by $7.5 billion. And that is the mechanism you need to understand first, because central banks usually treat gold like the final lock, the thing you guard when every other asset feels negotiable. So selling it sounds less like management and more like alarm. But the RBI has not confirmed a sale, and that matters because this story lives in the gap between data and statement. And the first consequence appears on the Rupee screen, where traders read thinner cushions before households feel any price change, so the gold question stops being abstract and starts moving outward. The pressure begins with reserves sliding to about $681 billion for the week ending May 22, which is still a huge cushion, but down from a late February peak near $728 billion, meaning the question becomes what kind of cushion gets used first, because dollars can be deployed faster than bars in a vault, especially when oil invoices arrive in hard currency, not sentiment, and India imports roughly 85 to 90% of its oil. So a crude shock does not stay inside commodity markets. It reaches the rupee through every refinery payment and tanker booking, which is why the dollar side of reserve becomes the working tool, while gold becomes the slower store that can be translated, not because the vault failed, but because the market needed motion. And here's where the story stops looking like panic, because one reserve asset can be quiet until the squeeze arrives now. The squeeze becomes human because a softer rupee spreads quietly, first through fuel, then freight, then the prices people notice. So the saver does not see a vault transaction. You see the grocery bill that arrives after the currency move, and that is why liquid dollars matter before headlines catch up, because defending a currency often means buying time, not victory, time for importers to pay, traders to breathe, households to adjust, but time still has a cost when the reserve cushion thins, and ordinary savers understand thinning cushions better than policy language. When your buffer shrinks, every next bill feels heavier, and for a country, that bill can arrive as crude. So gold sitting beautifully in storage cannot pay the tanker today, which is the uncomfortable part central banks rarely say aloud. The safest looking asset may be useful only after it changes form. That is the twist. Gold was not the treasure in this story. Liquidity was, because liquidity decides whether pressure becomes disorder. And the analysis suggests the RBI may have pulled that lever quietly, not to abandon gold, but to make part of it work, because gold's share had climbed towards 17% before this reading. So trading some exposure for dollars can be a lever, not a fire sale, not a confession, and not a confirmed admission. And if you miss that distinction, the whole story tilts wrong, because the vault is only one room in the reserve machine. And when the rupee comes under pressure, the machine needs parts. Some parts reassure markets, some pay bills, some buy time, and gold, the asset we imagine as untouchable, can do all three if a central bank is willing to stop treating it as decoration. So the next squeeze starts again with one question: why sell gold?